Hello everyone. Today we are going to understand the very basics of stock market, chart analysis. The very basic starts with understanding the market structure. Okay, uh, market structure is what tells you that the market is in uptrend, downtrend, or going sideways. To understand the market structure, we just need to think of a example. Let's take it for example. Think of a staircase. Okay. Think of a staircase which is going upwards. We have like this a staircase, right? If we are going upwards, the staircase would be like this only, right? This, like this. Yeah. Oh my god. And I just made a mistake. Little one. No problem. Yeah. And then here comes another part of the structure and the staircase also. And see, in this case, we are just going upwards, right? One after another, one after another, one after another. And in this kind of here, the stairs are one after one, above one, and going upwards. Okay. Here comes a slowdown where the stairs are turning in the other direction, or we are just halting, like we have just turned this amount upside and we are just now resting. Yep, this is the resting period for the stairs. Now comes the exciting part, the later half of the stairs, which is like this one. That's a bit wide, I guess, for the content, but that's okay, no problem. So here in this part, we are coming downwards. Okay, lower after lower after lower. The stairs are lower before the previous one. That's why we are coming, down. So I just want to put it this way because it is somewhat easier to understand, right? So that's the market structure. That's the basic of market structure. We are going upwards, a little pullback, then upwards, then little pullback, then upwards, then little pullback, upwards, pullback, upwards. Now here we comes a halt, a rest, just like as the stairs. Here the price generally halts at this point. Generally the traders are resting or they are just deciding the next direction. And when the next direction is downwards, then we are just coming downwards with little pullbacks here and there also. See, pullbacks are very much important because we are not able to fill up all the positions in the trade at once. So you think of it just like a bow and arrow. We pull the arrow to get it moving into the right direction. Okay, so this is also the same, that we are just having a pullback before another continuation, a pullback before another continuation, a pullback before another continuation. Okay, this one. Now the next part of the tracing it as higher highs, these are higher highs. Okay, like this point is higher than the previous one, this point is higher than the previous one, this high is higher than the previous one, this high is higher than the previous one, and this high is higher than the previous one. Now we come at the low of the points. These are called higher lows because these lows are higher than the previous one. Okay, so here comes this part, higher lows, higher lows, higher lows, and higher low. Now, this is the consolidation phase. Let me just, remove this one. I hope you are getting understand this thing. So here comes the second part, the lower lows or lower highs. See, these highs are basically lower than the previous one. So we name them as lower highs. Okay. Lower high, another lower high, another lower high. And these are the lows which are lower than the previous one. So we will call them a lower low, lower low, lower low. Yeah. So this tells us the basic market structure in which we have learned that the market has three phases. The higher high, higher high, higher low, higher low, higher high, higher low, higher low, high, higher low. And this generally depicts as an uptrend in the market. This phase is generally considered as a consolidation phase, and the case of lower highs and lower lows are depicted as a downward trend. So this completes our basics of the market structure. In the next video, we will learn about candlesticks, how they form and how they look. Thank you very much. Thank you for watching.